Hello everyone, welcome to the elective course of summer course by Finance and Business Department of Diponegoro University. My name is Naila Hanum and I'm honored to share this very special topic with you. We are going to talk about a closer look to ESG, the three pillars of environmental, social, and governance. This course is aimed to prepare you with the knowledge needed to respond to environmental, social, and governance inquiries and leverage this information to conduct more effective due diligence and make better investment decisions. So maybe you come with some question about what is environmental social governance and how is info used to assess risk, reward and management effectiveness, and how do stakeholder expectations influences corporate action, and finally what are key considerations for corporation investor. So we start on what is ESG. ESG comes up with three pillars, which are environment, governance, and social. The first one is governance. Governance criteria refers to a company's leadership and management philosophy, practices, policies, internal controls, and shareholder rights. Meanwhile, environmental criteria addresses a company's operations, environmental impact, and environmental stewardship. Finally, social criteria refers to how a company manages relationship with and creates value for stakeholders. ESG is used as a framework to assess how a company manages risk and opportunities that shifting market and non-market conditions create. This shift includes changes to environmental system, social system, and economic system, which is the whole system is impacted the entire landscape a company operates in. So basically, ESG is not about values. ESG is about the ability to create and sustain long-term value in a rapidly changing world and managing the risk and opportunities associated with these changes. So maybe you would know the history and evolution of ESG. ESG is often used interchangeably with corporate social responsibility or corporate sustainability. However, ESG encompasses much more. From 1980s, we called environment, health and safety or EHS based on the development of environmental and employee regulation. So, and then in 90s, we called it sustainability that focuses on reducing environmental impacts beyond legal requirements. From 20 until 2010, corporate social responsibility is begin to trend that company comply. Corporate philanthropy and employee volunteerism used to align social issues. And start from 2020, we called environmental social governance ESG as the more comprehensive term that holistic concept related to competitive advantage and risk and reward management. So these are three key factors in ESG's growth into the mainstream. The first thing is materiality, ESG's influence on investor risk and returns. Then we talk about transparency, greater transparency on how client money is invested. And finally, we also concern on regulation that address both national and international threats. For example, climate change. And for the key factors, we can see how company grow. So basically, it would result for a growth. Some high-profile examples of financially material ESG incidents which influence greater client, a demand for a transparency and regulatory demand for ESG to be recognized as fiduciary duty include this case that going viral. And for the example is BP from the 2010 BP's U.S. Deepwater Horizon oil spill, where BP received 53.8 billion US dollar in fines, cleanup costs, and local reparations. And the second case is from Volkswagen from 2015. The company was charged 27.4 billion euro in penalties for rigging 11 million diesel vehicles to pass emission tests. And then the final case is from Cambridge Analytica from 2018. Analytica harvested the personal data of 87 million Facebook users, resulting in FB losing billions in market value. So, why ESG is important? ESG has a significant positive impact on fundamental business issues relevant to the long-term success of any company across industries. We can see it from corporate reputation. ESG can enhance a company's license to operate, making it easier to accomplish business objectives and respond to crisis scenarios with key stakeholder groups. In the Cambridge Analytica 2018 case, Facebook lost billions in market value due to their tarnished reputation in managing cybersecurity attacks. And then it's significant for risk reduction. ESG helps identify immediate and long-term risks. For example, material and labor availability, evolving regulation, depending on the industry and business model. A food production company in the Western United States is dependent on a large local labor force to produce and distribute their products, and highly susceptible to natural disasters that occur due to climate change. And then opportunity management is about shifting market and non-market conditions can expose unmet needs for new products or services, unserved or undeserved customer bases, and strategic relationship for addressing ESG issues. Unilever's ESG effort in emerging markets have resulted in greater profitability and market penetration, as well as positive societal impact as they provide a wide range of training and support to independent stores, kiosks, and micro businesses in the area. And finally, we have culture and intrinsic value. ESG maturity is an indicator of a company's commitment to build a high-performing, purpose-driven workforce and inclusive culture. Integrating ESG factors into valuation allows for greater insight into intangible factors such as culture, talent recruitment and retention, operational excellence, and a risk that can improve investment outcomes. So, in short, corporate reputation can enhance customer and investor acquisition. Meanwhile, risk reduction can reduce disruptions and losses. Opportunity management can make a greater workforce productivity and organizational resilience. And finally, culture and intrinsic value, identification of new markets, customers, products, services, and revenue streams. So we talk about ESG factors, environmental issues, and then social issues and governance issues. All have a material impact on a wide spectrum of industries. The first one we talk about environmental issues that also impact on climate change, natural resource scarcity, and pollution and waste. Climate change worsens both conventional and ESG-related risk. Natural disasters due to rising temperatures present significant risk. For example, for a REIT, climate change presents a portfolio risk to all CRE. Risk assessment should account for impact on the assets as well as the insurance and maintenance costs. And then we go to natural resource scarcity case. Changing environmental conditions have increased the depletion of natural resources, which have become more important to stakeholders. For example, when conducting due diligence for a multinational food company, one of the material risks to account for would be the depleting global water supplies. And then we have pollution and waste that cause reputational risk, which influences product and R&D, retail expectations, and consumer requirements. Pollution can also cause health concern that influence license to operate, which can have legal and regulatory ramification. For example, polluted beaches have an impact on local tourism, travel, leisure industries, and also analysts responsible for capital allocation should monitor waste management. So all of that environmental factors may not impact the company or portfolio directly, but it will have a material impact on key stakeholders such as customers, consumers, or suppliers. Annual research shows that employee engagement has a direct impact on profitability because it can engage employees, provide 21% greater profitability versus the case of disengaged employees that cost company about 450 until 550 billion dollar per year. And then it's about communities, the welfare of communities that supply materials, house assets, production sites, and labor are linked to welfare of company interest, enhancing the company's license to operate. Reporting, transparency, and business ethics also make investor will consequently have to make assumption about management quality when company product info is limited. So transparency could help that issues. Leading and most incredible disclosure framework is about industry-specific standard from the Sustainable Accounting Standard Board, SASB, cross-industry recommendation from Task Force for Carbon-Related Financial Disclosure, TCFD, and the Global Reporting Initiative, or GRI. And then we talk about corporate pressure and stakeholders' expectations. Stakeholder value creation plus stakeholder capitalism could make capital allocation. So, stakeholder is anyone who is affected by or can affect the business. Meanwhile, stakeholder capitalism creating value for all stakeholders, not just as shareholders. So we should differentiate about internal shareholder and external shareholder. This is the company. Internal shareholders is about owners and employees, and then external shareholder is consist of customers, suppliers, investors, creditors, media, communities, trade unions, and governance. Okay, then the quality of these relationships can dictate the company's ability to manage risk and opportunities. Effective stakeholder management also support crisis response and business continuity planning. Okay, then we talk about investor. Large institutional investors have publicly declared ESG criteria will guide their decision-making on investment decision, especially when there is climate-related risk. So the investor basically is start to aware about the climate-related risk. So investor have expectation. They are expect greater clarity and accountability measures for ESG effort. So company have to some procedure that to assess progress on ESG issues, enhance disclosure and reporting, and also finally they have to make ESG integration. For example, in 2020, BlackRock publicly announced that ESG issues will be guiding all their decision making moving forward, prompting the investment community to follow suit. Okay, and then from employees' point of view, employees management, that increase is equal with ESG maturity that also increases. In today's labor market, where companies serve a higher purpose than generating profit and retaining talent, you should identify your employees. Especially, it's about millennials that have been responsible for influencing societal norms around key ESG issues in the current market. Meanwhile, the Gen Z employees has been engaged in these types of issues throughout their childhoods and expect employers to share these values. So, in this technology era and a load of information, negative events that happen far away are easily surfaced through social media and greater stakeholder awareness. So it will result on companies more considered accountable for negative impact along supply chains and third-party contractors. So understanding the company's approach to supply chain management can give a good indication to how they manage risk across the enterprise. Check supplier code of conduct, comprehensive oversight protocols, and long-term strategy to reduce the risk associated with supply chains. ESG impacts can influence all parties along the value chain due to their interconnectedness and dependency. The first one is reduce risk, is for mitigates risk to the enterprise. And second is increased opportunities and growth, is to support identification of new market, customer, and product or services. And the third one is organizational resiliency, that anticipates and adapts to technological, customer, and regulatory changes. The fourth one is workforce productivity, that engages and empowers employees, increases retention, and attracts best talent. And finally, we have reputation and stakeholder trust. It's about increasing stakeholder trust for better corporation reputation. The impacts of this initiative have led to investors asking for more content and disclosure on corporation to further develop the following: corporate purpose, scenario planning, and translating risk to opportunities. For corporate purpose beyond profits is important to develop as it provides insights into decision making and long-term resilience. And meanwhile, scenario planning is about companies are expected to plan for a climate catastrophe with detailed disclosure and navigating physical transition and market labor risk. And the translating risk to opportunities is facing the challenges. For example, natural resource scarcity present opportunities to launch new ventures and address the challenge through a profitable market-based solution. So in Indonesia, we care about ESG, and we also have the mechanism of ESG investing, reverse to an investment activity that not only consider financial metrics but also to consider ESG factors as the basis of the decision making. These factors are very important to be considered in our investment decision to measure the risk factors, sustainability, and potential growth of the company. A company's financial performance is closely tied to the ESG risk it faces, as a company does not operate independently. Therefore, a company cannot expect to operate sustainability in the long term without practicing good corporate governance and to take into account the impact of its daily operations towards the environment and the society. Information regarding ESG aspect of Indonesian publicly listed companies can be obtained through their sustainability report that may be issued as a separate report or integrated in the company's annual report. So, ESG investing in Indonesia, the Indonesia Stock Exchange understand the importance of ESG investing values in the long run to support the growth of sustainable financing in Indonesia capital market. The exchange has issued a regulation to support and incentives the green bond issuance in Indonesia through rule number 1B. So we have the special index here. On top of that, the Indonesia Stock Exchange has also issued 4 ESG-based indices. The first one is basically ESG leaders, an index that measures price performance of 15 until 30 stocks that have good environmental, social, and governance and do not have significant controversies, selected from stock with high trading liquidity, which also have good financial performance. ESG scoring and controversy analysis are conducted by Sustainalytics. And then we have the second index that called Sri Kahati, an index that measures the stock price performance of 25 listed companies selected by Kahati Foundation that had good performance in encouraging sustainable business as well as having an awareness of environment, social, and good corporate governance, or called sustainable and responsible investment, SRI, or Indonesian tongue maybe would call it Sri Kahati. Sri Kahati is a jointly developed index with the Indonesian Biodiversity Foundation or Kahati Foundation. The third index is ESG Sector Leaders EDX Kahati. It's an index that offers broad market exposure and diversification by choosing representative in each industry with best ESG score. Stock with above average ESG score are selected to represent the industry and grouped by EDX industry classification. This index is jointly developed with the Indonesian Biodiversity Foundation or Kahati Foundation. And the last one, we have ESG Quality 45 ADX Kahati, an index that measures the stock price performance of 45 stocks that consider the quality of financial and ESG aspect with relatively large market capitalization and high liquidity. This index is jointly developed with the Indonesia Biodiversity Foundation. So it's your time to gain a better understanding. So please have a brief analysis of one of the companies in ESG indexes that catch your attention. So after that, you should think about that. You have the question, should you invest your money in that kind of company, and show us your reason. Thank you and see you later.